Welcome to my channel. I'm so glad you're here. Today we're diving into something really important that you won't want to miss. If you enjoy thoughtful content, don't forget to like, share, and subscribe. And follow us on whichever social media platform you're watching. Your support means everything. Now let's get into today's topic.
Okay, let's unpack this. When it comes to managing your money and borrowing for those big or even small life moments, you've probably encountered two major players, personal loans and credit cards.
Definitely. They're everywhere.
Right. Today, we're diving deep into the sources you've shared, everything from articles to your own personal notes to pull out the most important nuggets of knowledge.
Mm-hmm.
Our mission is to help you really understand the unique structures, the unexpected benefits, and yes, the crucial drawbacks of each.
So you can make a truly informed financial decision.
Exactly, one that feels right for you.
It's interesting because while both options clearly allow you to borrow money, they operate on fundamentally different principles. It's truly not a one-size-fits-all situation.
No, not at all.
The real insight here isn't just that it depends on your situation, but that your financial personality, whether you're a meticulous budgeter, someone who thrives on flexibility, or perhaps prone to impulse, should dictate your choice.
Okay.
Think of it as choosing the right tool for your internal wiring, not just the task at hand.
That's such a great way to frame it, matching the tool to your own habits. So let's start with personal loans. What exactly are they at their core?
Okay. So, at its core, a personal loan is a form of installment credit. You receive a lump sum of money up front.
Right, one big chunk.
Exactly. And then you repay it in fixed monthly payments over a predetermined period, typically ranging from, say, 1 to 7 years.
So it's essentially a one-time cash injection that you pay back in predictable chunks. How much can someone typically borrow, and what factors influence that?
Precisely. The amount usually varies between maybe $1,000 and $100,000. It largely depends on your creditworthiness, income stability, and other financial factors.
Makes sense.
Now, what's really important to grasp here is the distinction between secured and unsecured loans. Most personal loans are unsecured.
Meaning no collateral.
Right. You don't need to put up collateral like your car or house. However, if your credit score is on a lower side, you might only qualify for a secured loan, which does require collateral.
You mentioned secured loans often come with lower interest rates because the lender has something to seize if you default. Does that mean if someone can offer collateral, it's almost always the smarter move, or are there hidden risks even there?
That's an excellent point. While secured loans do typically offer lower rates because the lender's risk is reduced, the primary hidden risk is, of course, losing that asset if you default.
Yeah, that's a big one.
For many, that risk is just too high. Beyond that, personal loans also come in fixed versus variable rate options.
Okay.
Fixed rate loans mean your interest rate stays constant throughout the term, making payments incredibly predictable, easier to budget.
That sounds good.
Variable rate loans, on the other hand, mean the interest rate can change. You might start with a lower rate, but there's a risk your payments could increase over time. So the question for you becomes, how much predictability do you value in your budgeting versus potentially chasing a slightly lower initial rate?
That predictability sounds incredibly appealing, especially for long-term planning. So what's the big upside when it comes to personal loans? Why might someone choose this path?
Well, those fixed interest rates are definitely a standout benefit. Unlike credit cards, which often have variable rates that can fluctuate, personal loans offer stability.
Total stability.
You'll always know exactly how much you're paying each month, making budgeting almost effortless. If your loan has a 7% interest rate and a 3-year term, you can calculate to the penny what you'll owe, and it never changes.
That predictability is a real game changer.
It really is. It helps you stick to a budget and gives you peace of mind.
Absolutely. That stability is especially useful when dealing with long-term financial commitments. I've seen situations where that fixed payment acts as a powerful accountability tool. It's like setting a clear finish line for your debt.
Precisely. And if we zoom out for a moment, personal loans are ideal for large one-time expenses,
Like what?
like significant medical bills, financing a wedding, or tackling a major home repair. You get the lump sum you need up front. And then you pay it back in manageable monthly installments, all with a clear end date. Compare that to credit cards, which are generally better for smaller, recurring charges.
Big difference.
Huge. If you borrow, say, $10,000 for a kitchen remodel with a 3-year personal loan, you'll know exactly when it'll be paid off and your total cost.
Clear path.
With a credit card, you might hit your limit, or worse, fall into the trap of making only minimum payments. which can stretch repayment out for a decade or more.
Oof, yeah.
Plus, using a personal loan for large expenses can help preserve your credit utilization ratio, which is a major factor in your credit score.
That's important.
And for those with good credit, you can often secure a much lower interest rate compared to a credit card. While average credit card APRs hover around 20% or more,
Which is really high.
personal loans for creditworthy borrowers can offer rates as low as 5% to 7%. This difference in interest can genuinely save you thousands over the loan's life. I mean, potentially thousands.
So that fixed rate and the ability to preserve your credit utilization ratio are huge draws.
Hmm.
Of course, like any financial tool, personal loans aren't without their catches. What should listeners be wary of?
Well, for starters, the eligibility requirements can be quite strict.
Okay.
To qualify for the best rates and terms, you'll typically need good to excellent credit, a steady income, and a low debt-to-income ratio, meaning essentially how much of your monthly income is already consumed by existing debt payments.
Right.
If your credit score is, say, below 640 or your income isn't consistent, you might be denied, or only qualify for loans with much higher interest rates.
So access can be an issue.
It can. It's also worth noting that many lenders do a hard credit pull when you apply, which can cause a small temporary dip in your credit score.
Good to know. And beyond eligibility, are there often hidden costs that can sneak up on you?
Absolutely. Unlike most credit cards, which typically don't have upfront costs, many personal loans come with fees, especially origination fees.
Origination fees?
Yeah,
What are those exactly?
they can range from 1% to 8% of the loan amount and are either added to your loan balance or, more commonly, subtracted from the funds before they're dispersed.
So you don't even get the full amount.
Often, no. So if you borrow $10,000 with a 5% origination fee, you'd only receive $9,500. It's crucial to factor these into your budgeting.
Definitely.
Some lenders also charge prepayment penalties if you decide to pay off your loan early, which can eat into your savings, though thankfully, many lenders have moved away from this.
That sounds like a tricky detail for budgeting losing part of the loan right off the top.
It can be. And then there's the limited flexibility. Once you receive the lump sum, that's it. You can't borrow more without applying for a brand new loan.
Ah, so it's a one-shot deal.
Exactly. Unlike credit cards, which allow for continuous borrowing and repayment, personal loans are a one-and-done deal. This can be inconvenient if you miscalculate how much money you truly need.
Which happens.
And you're locked into those fixed monthly payments, which can become a burden if your financial situation unexpectedly tightens.
All right, so that's personal loans. Predictable, good for large sums, but potentially hard to get and inflexible. What of their counterpart, credit cards? We all know them, we probably use them, but how do they really stack up differently in practice?
Sure. A credit card is essentially a revolving line of credit. You're issued a spending limit, and you can borrow, repay, and then borrow again continuously.
Up to that limit.
Exactly. As long as you make at least the minimum payments on time, each time you use it, you're borrowing.
And what about interest on these? Because that's where credit cards can become really expensive for us.
Precisely. If you pay off your balance in full within the grace period, which is typically 21 to 25 days after your statement is issued, you won't be charged any interest.
Which is great.
However, if you carry a balance beyond that, interest starts accumulating, and rates can be quite steep, often ranging from 15% to 30% APR, sometimes even higher depending on your credit score and the card type.
15 to 30%. Wow. Okay, and within that world, there are so many different types of credit cards. What's worth highlighting?
Well, an interesting aspect here is how strategically using some of these cards can actually add up to hundreds or even thousands a year in rebates if you're disciplined.
Rebates. How so?
Take rewards credit cards, for example. They offer points, miles, or cash back on purchases. Some give a flat rate, like 1.5% or 2% back on everything, while others have bonus categories like 3% back on groceries or 5% on travel. Then you have balance transfer cards.
Right, the 0% APR ones.
Exactly. Specifically designed to help you pay off high-interest debt by moving it to a new card with a 0% introductory APR, often lasting 12 to 18 months.
Very useful.
And for those building or rebuilding credit, secured credit cards are incredibly useful. These require a cash deposit, which typically serves as your credit limit, helping you establish a positive payment history without much risk to the lender.
The idea of rebates or free money from credit card rewards is incredibly appealing, and I think it's a big driver for many people. But to truly benefit, it hinges on discipline, doesn't it?
It absolutely does. The free money from credit card rewards isn't truly free. It's a rebate on disciplined spending. the moment you carry a balance.
That costs you.
Exactly. That rebate flips, becoming a hidden interest surcharge that almost always costs more than the reward itself.
That's a critical insight for anyone looking at reward cards. So, beyond the rewards, what are some other perks that make credit cards so appealing?
Well, the sheer flexibility and convenience are huge.
Yeah, you can use them anywhere.
Pretty much. You can make purchases virtually anywhere, online, in-store, overseas. That's a level of accessibility personal loans just can't match. Need to pay for groceries, book a last-minute flight, or cover an unexpected expense.
Cards right there.
A credit card has you covered instantly. And because it's revolving credit, you can use your card repeatedly as long as you stay within your limit and make your payments. You don't need to reapply every time you need more funds.
Sure.
Plus, there are often built-in protections against fraud, which is a significant peace of mind.
Definitely. And that leads right into the long-term financial benefits. I imagine responsible use here can be incredibly powerful for your overall financial health.
Oh, it can be transformative for your financial profile. Responsible credit card use is incredibly useful for building credit history.
How so?
It directly impacts several key factors of your FICO score, your payment history, which makes up 35% of your score.
The biggest chunk.
Right. Your credit utilization, meaning keeping your balances low, ideally under 30% of your credit limit, the length of your credit history, and your credit mix.
So paying on time and not maxing them out.
Exactly. Making on-time payments each month and keeping balances low significantly contributes to a positive credit history. Looking at the broader impact, good credit opens doors to better loan terms, lower insurance premiums, and can even influence rental applications or job opportunities.
So using a credit card strategically can genuinely improve your future borrowing power across the board.
Yeah.
You also mentioned those 0% intro APR offers. How significant are those for short-term financing?
They're incredibly significant. These promotions typically last anywhere from 12 to 21 months and can apply to new purchases, balance transfers, or both.
That's a long time, interest-free.
It is. During this period, you won't be charged any interest, which provides fantastic short-term financing. Say you need to make a $3,000 purchase and you qualify for a card with an 18-month 0% intro APR.
Okay.
You can pay that $3,000 back at about $167 per month, entirely interest-free, provided you pay off the full amount before the promotional period ends.
That's the key part.
Absolutely. It's like an interest-free loan, but you absolutely must be disciplined enough to pay it off in time. Just remember to watch out for balance transfer fees, which are usually 3% to 5% of the transferred amount.
Right. Another potential cost. That's a powerful tool, but as we keep hearing, discipline is the key word. And with great convenience comes potential pitfalls. So where do credit cards really become a risk if not managed carefully?
The most obvious downside is those high interest rates.
Yeah, we touched on that.
As we mentioned, average APRs are between 18% and 24%, and for those with lower credit scores, they can climb to 30% or more. This means if you carry a balance from month to month, interest can quickly spiral out of control.
Making things way more expensive.
Exactly, making your debt far more expensive than the original purchase.
That high interest, combined with the ease of use, seems like a perfect storm for overspending. What's the psychological impact there?
It's quite fascinating, actually. The convenience can be dangerous. It can lead to impulse buying and a vicious cycle of debt.
Easy to just swipe or click.
Almost too easy. Credit cards make it almost too easy to spend money with just a swipe or a click, even if you don't have the cash readily available. Studies show people often spend more when using credit cards versus cash.
Because it doesn't feel as real.
Sort of. You don't feel the same immediate tangible loss. This ease can quickly lead to potential for long-term debt. Because you only need to make a small minimum payment each month, it's deceptively easy to fall into the trap of carrying a balance indefinitely.
The minimum payment trap.
Right. For example, if you have a $6,000 balance with an APR of 20% and only make the minimum payment, it could take over 15 years to pay off.
15 years.
And you might pay more than $7,000 in interest alone, more than the original balance. This contrasts sharply with personal loans, which come with fixed repayment terms and a clear end date.
So beyond the financial numbers, the deepest insight is recognizing the psychological cost of debt. Fixed-term loans offer a clear path to psychological freedom, while revolving credit, unchecked, can create a perpetual mental burden, even if the financial numbers seem manageable.
Precisely. The mental weight of ongoing debt shouldn't be underestimated. It really takes a toll.
So what does this all mean for you, the listener? How do you actually choose between these two powerful financial tools for your own situation.
It really comes down to matching the tool to the specific task and, importantly, your financial habits.
Okay. When would a personal loan be the better call?
You might choose a personal loan if you're looking for debt consolidation, especially if you're juggling multiple high-interest credit card balances.
To simplify things.
Right. It streamlines your debt management into a single, typically lower interest payment and sets a definitive payoff timeline, offering that clear path to debt freedom we just discussed.
Makes sense. What else?
Personal loans are also great for larger defined projects like home improvements, financing major renovations with a lump sum and predictable payments, potentially increasing your property value without necessarily leveraging your home as collateral for unsecured loans, of course.
Gotcha. And when do credit cards truly shine?
Credit cards are often the better choice for everyday purchases and travel.
The convenience factor again.
Absolutely. Their sheer convenience, the ability to accumulate rewards, robust fraud protection, and added travel perks like trip cancellation insurance or rental car coverage are hard to beat.
And short-term needs.
Yes, they're also excellent for true short-term financing. If you need quick cash flow for unexpected expenses, especially if you know you can pay it off within the grace period or during a 0% intro APR offer, they provide quick relief.
Like an emergency fund backup.
Kinda. You can borrow now and pay later interest-free for a significant period, which is a solid deal if you're disciplined enough to meet the repayment deadline.
So it seems personal loans typically offer lower interest rates and a fixed payoff schedule, providing that predictability.
Right.
While credit cards have higher APRs, but offer more flexibility and those appealing rewards, especially with intro offers, it's a clear trade-off.
It really is. And remember, both impact your credit score, but differently.
How so?
Credit cards affect credit utilization. You want to keep your balances under 30% of your limit to maintain a healthy score.
Okay.
Personal loans, as installment loans, affect your credit mix. Having different types of credit, like installment loans and revolving credit, can actually be good for your score as it diversifies your credit profile and shows lenders you can responsibly handle different types of borrowing.
So having both used responsibly can be beneficial.
It can show financial maturity. However, timely payments are paramount for both. That payment history makes up 35% of your FICO score. So, regardless of the type of credit you choose, paying on time every month is essential for building and maintaining a strong credit profile.
This has been a comprehensive deep dive into personal loans and credit cards. Reflecting on everything we've covered, what do you think is the single most important takeaway for our listeners to act on right now?
Well, like we said, there's truly no universal answer. The best option depends on your unique financial situation and goals. But if I had to distill it down, the deepest insight is this. Both tools can support your financial well-being, or they can lead to burdensome debt.
It's all in how you use them.
Exactly. The difference comes down to informed choices and consistent discipline. Beyond the numbers, you need to understand your own relationship with money, your comfort with risk, and your ability to stick to a plan.
So the key actions.
Pay on time, every time. Don't borrow more than you can truly afford to repay. Be mindful of all fees and interest. And regularly review your credit report and track your spending.
Sounds simple, but hard in practice sometimes.
It can be. Ultimately, knowledge is most valuable when it's understood and applied to your specific financial personality. Know thyself, financially speaking.
Thinking about everything we've just uncovered, how might understanding your own personal money habits, whether you're a meticulous planner who needs that fixed structure or someone who thrives on flexibility but maybe can get carried away, influence which of these borrowing tools will truly serve you best in the long run?
That's the core question.
Thank you for sharing your sources and joining us on this deep dive. We encourage you to continue exploring your own financial decisions with this new understanding.
Thank you for watching this video. I'm so glad you're here. If you enjoyed our thoughtful content, don't forget to like, share, and subscribe, and follow us on whichever social media platform you're watching. Your support means everything. Now see you soon in our upcoming video. Stay tuned and stay blessed.